Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the program, my guests and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate market will be covered here. If you got credit issues, you can call me. If you're looking to buy or sell your home, you can reach out and call me. If you're looking to refinance to the lowest rates in U.S. history, which right now they're ridiculously low. I mean, sub 4% interest rates. I mean, we've been talking week in and week out. They're just, absurdly low. Obviously, a lot of government manipulation that are keeping them slow. Highly recommend that you reach out and call me. I gladly let you know what your options are as far as purchasing a property or refinancing to these lowest rates in U.S. history. It's 877-245-2030. That's 877-245-2030. Make sure you join us every Monday at WNEW 1580 AM from 2 to 3 p.m. in the afternoon. We're going to be, here every week. And remember, if it's real estate, it's covered here. We've got a great show lined up for you guys today. A lot of stuff going on, transpiring in Europe as it has for the past couple months. Joining me on our panel to discuss the many issues of today is Louis Cammarosano, who is the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you about what happened in the markets last week, as well as what's on deck this week that can affect you in your real estate decisions. Louis, how are you doing today, buddy?
I'm grand. And yourself, Ryan?
I can't complain. Just another Monday.
Good.
But, yeah, everything is going well on this front. It looks like, we've got a lot transpiring over in Europe again. It looks like Spain now is a part of the contagion has spread to them now, or at least in the media at any rate. And it looks like they're on verge of collapse, and now the EU has reached out and basically said that they're going to make a move to bail them out for a sum of somewhere around 100 billion euro. A few thoughts that I have, maybe a few questions you might be able to answer. Where is this money actually going to come from?
Thin air. ECB prints it up and lets them have it.
So just similar to what the Fed's doing here in the United States.
Yes, and there's a lot of call now for the ECB to become like the Fed and to basically put all the finances of all the member states in the EU under the ECB so that they can handle these crises whenever they feel like it.
Yeah,
and not have the individual countries have much to say about how they run their own finances.
Yeah, and it's interesting to me because I think it was sometime last week the European Union had unveiled their bank bailout plan, which was actually part of it was very similar to what's we have here in the United States, where they were proposing that they would include a single deposit guarantee organization similar to the FDIC. So it's almost like, okay, let's look at what the United States is doing and do the same thing, although they don't realize that we're in a worse position than they are.
Sure. When you have these low rates, in a debased currency because you print up more money and the sovereigns owe a large amount of money, we've been talking week in and week out. If that was the profile of your typical borrower, you would you'd want to get a much higher rate of interest from that person.
Absolutely.
But the real key is that because they can print the difference, that somehow gives the person who's purchasing the debt some comfort. Like in the United States, the interest rates are very low because there is confidence in the United States that they'll be able to repay. Now, what happened in Spain, Greece, and Italy, the interest rates rose because investors lost confidence in their ability to pay. Now, they'll gain confidence because the ECB will backstop their debt, but it doesn't solve the underlying ability of any of these entities to pay, because if they do end up paying by printing up money, they're in effect defaulting, but they're defaulting not by not paying, they're defaulting by giving you a debased currency.
Right. Yeah.
And as that it reflects with real estate, it just basically means that in a normal circumstances, interest rates would be much higher than they are. And so this is, in a sense, a gift from the Federal Reserve and from thanks to the European banks as well, that you can get interest rates for 4% and 3% on a long-term mortgage. And you know that this is artificial because the creditworthiness of these sovereigns is not worthy of these low interest rates that they're able now to offer their debt at.
Yeah.
That was the whole purpose of the bailout, was not just to make the banks solvent, was to make it possible so that the sovereigns, Italy, Spain, Greece, and so on, wouldn't have to lend at 6-7%.
Right, exactly.
Now, that hasn't happened in Spain. I think the interest rate is still, even after the bailout was announced, is still, you have to pay, they still have to pay over 6%. But, in a way, interest rates that are high are good for sovereigns because it means that they can't borrow more money.
Yeah.
It actually acts as a brake on the ability of the sovereigns to continue to spend money that they don't have, because then their interest service debt becomes even higher. It becomes harder to service the debt at 6% than it does at 2 or 3%.
Yeah, and you said it as if this is a gift to people here in the United States right now, with all that's going on in Europe, and they're having it's mass chaos over there. I mean, in the end of the day, I almost feel like in the upcoming Fed meeting, Louis, that's coming up here, I believe it's the 17th and 18th of June or something like that. I believe that Bernanke's going to give some sort of language that he's here to support them, or something along those lines, to try to build confidence as if we're once again we're the superpower and going to help everybody out. And I really look for U.S. interest rates to stay in a relatively narrow range. Right now we're sub 4% depending upon your qualifications, and I really don't look for much to change between now and the next month or so.
In a normal market, they would, except that all the central banks have a vested interest in keeping them low, and they will do whatever it takes to keep them low.
Yeah, and it's very interesting because you bring up a good point, because with all this manipulation, it's very hard to even try to figure out, okay, and based upon normal market conditions, you would think that, hey, interest rates have to go up.
And you'd be running away from bonds right now.
Absolutely, but that's not what's going on right now. And you and I have been wrong before, because we're making assumptions based upon a free, normal working market, and that's not what we have going on here. So in essence, this gift is something that people should really be paying attention to, because it might not ever happen again. Once interest rates start to rise, they rise very quickly. Now, could this go on for the next 2, 3, 4, 5 years? Possibly.
The ability to kick the can down the road has been pretty remarkable.
Absolutely. And at this point, I mean, there's 15 trillion in debt that's been issued by the government, the treasuries, of which the Federal Reserve probably has, at least probably 50 to 60% of that.
Right. You know what else is remarkable, Ryan, is that the situations in Greece, Italy, Spain, and so on have been there. They just haven't been focused on. I mean, they've had their high debt-to-GDP ratios. They've had all the earmarks of problems. It's just nobody focused on it. It's the same with the United States. At some point, confidence is all a matter of almost the collective wisdom or stupidity of crowds and investors. I mean, during the Internet bubble, there was a bubble. People just didn't want to pay attention to it until everyone paid attention to it, and then everything came crashing down. I mean, that's eventually going to happen when people realize that all these bailouts are just papering over problems, and they're not solving the underlying problem, that sovereigns have taken on far too much debt that they'll never be able to repay, and they're taking no steps whatsoever to really cut spending. And when they do cut spending, there's a hue and outcry that austerity doesn't work and that we have to keep flooding the system with more money. And because of that, we're going to have these low interest rates, or they're going to try to keep them low until people wake up and realize that the money is going to be devalued and people aren't going to want these bonds, and they're going to want to move into more secure assets. And right now what's happening is people are buying stocks to stay ahead of inflation. But eventually there'll be a move more, I predict, into gold and silver and things that are money, real money that don't lose their value in light of this. But that really hasn't happened. You've seen more money flow into the stock market, into U.S. Treasuries, instead of into gold and silver.
Absolutely. I mean, we've seen, I still feel like there's a lot of savvy companies out there that actually do have a good chunk of their money in gold and silver. They've actually invested in the gold and silver. But it's not. I wouldn't say that it's the majority of people out there. At least the price is not indicative of that.
I think less than 1% of investable assets are in gold, silver mines, gold mines, and so on. And that's why I say it's not in a bubble, because you ask the man on the street to name 3 or 4 silver mining companies, he can't. And you ask him what the price of gold is, they won't be able to tell you. So you have a bubble when everybody is focused on an asset, and that asset is overbought, and there's a lot of speculative froth. Just because the price has gone up doesn't mean that silver and gold are in a bubble.
But don't you also think that there's a lot of people out there that think that, if gold and silver prices were to start to shoot through the roof, that would also almost be indicative of the U.S. economy struggling?
Gold is an indicator, right? Gold is a counter indicator to the value of the dollar.
Yeah.
Gold is considered the fear trade, what people buy when they're worried. But and confidence, that's an emotional thing. It's not it ties into economics. But when people worry about the value of the dollar, as they did in 1979, 1980, they flooded into gold. And then there was a gold bubble. And then that bubble got popped when Volcker increased interest rates up into the teens.
Yeah.
To kind of put a hold on inflation. We're seeing the reverse interest by all the central banks. They have no interest in shutting down inflation. They have every interest in creating more and bailing out everyone to make sure that interest rates don't rise.
Yep. You're listening to Real Estate 360 Live. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. I find it interesting, too. Heading into this election, it's kind of like almost all of a sudden consumer sentiment seems to have gotten a little bit better. Gas prices have come down significantly over the last month or so. It seems as far as mortgage rates, they've stayed low. They've gotten actually lower than they were before. So heading into this election year, I find it's almost ironic of how everything starts to come together right before the election. You know what I mean? It's like everything is just adding up to make it seem like everything is just peaches and cream, and really it's not. And
you saw the president the other day, didn't you, Ryan, where he came out and he said the private sector is doing just fine, and he was making a play for more federal funding and more state funding of the public sector, more fired in teachers and government workers.
Right. Yeah.
And that fell on deaf ears, I think, for the most part.
Well,
even Krugman had to kind of say that he misstated that the private sector is doing fine, but Krugman went on to say that more jobs need to be created in the public sector, as if the public sector adds as much to the economy as the private sector does by having bureaucrats push papers.
And then I think also one of the top leading members of the Bank of England came out and said that it's time for central banks, including the Bank of England, to start buying private assets and get their money out of a lot of these government-backed securities and whatnot. I think it's really going to be interesting to see how things transition between now and the beginning of next year. Obviously, my thoughts is that I really feel as though interest rates will probably stay in a range. I don't really think that they're going to head much above 4.5% because they really can't. And I think
about interest rates on the 30-year mortgage?
Yeah, 30-year mortgage. I feel like that they're going to probably stay in this narrow range, probably not heading above 4.5%. Obviously, we know that the Fed is a big buyer of treasuries, and they've got all these Operation Twists and all these different things to be able to manipulate the market to keep things at a sustainable level to continue to kick the can down the road. At which point, we're always talking week in and week out as like we don't know how long these interest rates can stay at these levels. But it's just like I feel like we've been going on for so long now that this could continue on for a couple of years.
Yeah, but you have to put housing prices aside, because at some point when you have real price inflation, not just inflation created through the increase in the money supply, when that finally finds its way to prices, it'll find its way through all prices, including housing prices.
Yeah.
So eventually your house may not go up in the next 2 or 3 years. It may still be subject to the supply and demand market forces, and also because you've got foreclosures and short sales. But eventually, as all prices rise, the housing price will go up too. But the key is, if you have that 30-year mortgage, your mortgage payments will not rise.
Exactly. They're protected.
They're protected, and that is the real important thing if you're looking long-term is your house may not rise in the next 2 or 3 years, but eventually, the type of inflation we should be having, the house price will rise too.
Yep, absolutely.
And your rents will be rising, and you'll still be paying your 4% mortgage rate.
877-245-2030. We're coming up on a break. When we come back, we're going to jump into the results of the HomeGain second quarter 2012 National Home Value Survey when we come back. Stay right there.